Florida House Bill 1203 established a new legal framework that mandates the exact parameters of association financial audits. Failing to meet these standards carries immediate consequences. Current statutes classify specific financial mismanagement and missing documentation as criminal acts for sitting board members. To navigate this, we are going to build a complete, legally compliant Florida audit and risk readiness portfolio, step by step. Mastering these mandatory compliance measures protects the community's financial assets and shields the board from personal liability. The strictness of your community rules and your baseline financial risk depend on how your property is legally structured. This comparative matrix maps out the three types of communities. On the left, Chapter 718 condominiums carry the highest strictness and financial risk. Because owners only possess the airspace inside their drywall, the association is legally mandated to manage structural reserve funding. Moving to the middle column, townhomes act as a hybrid. Owners typically hold fee-simple rights to the physical structure, but they still carry shared risk for connected roofs and must adhere to exterior architectural uniformity across the attached row. Here in the third column, Chapter 720 single-family HOAs serve as the baseline. Homeowners privately own the structure and the land, creating an environment with minimal shared financial risk for the association. Correctly identifying whether your property falls under Chapter 718 or Chapter 720 is the first step to determining your board's specific legal audit burden. On July 1, 2026, the Florida legislature will implement new reporting tiers based on association revenue. This revenue tier ladder shows the 2026 adjustment. Any Florida HOA generating $250,000 or more in annual revenue is required to obtain a full independent CPA audit. Looking below that new hard audit line, associations generating between $150,000 and $250,000 must produce compiled financial statements, while those under $150,000 are restricted to basic receipts and expenditures reports. Notice the flashing warning indicator on the $250,000 line. Under Florida Statute 720.303.7, known as the Anti-Downgrade law, boards are legally prevented from lowering their reporting tier in consecutive years. If your association triggered a full audit last year, you cannot drop back down to a simple review. This ensures a temporary dip in revenue cannot be used as a loophole to hide books from an auditor. A proper audit requires an independent, licensed CPA who specifically specializes in Common Interest Realty Association, or SIRA, accounting. They will request 4 specific categories of documents. This 4-quadrant checklist graphic tracks the required evidence. First is governance. The CPA will request 1 full year of board meeting minutes to verify that every major financial expenditure was voted on and approved in an open meeting. Second is banking verification. You must provide monthly bank reconciliations for all operating and reserve accounts, alongside the community's most recent statutory reserve study. Third, they examine revenue. You need the approved annual budget versus actual spending reports, explicitly focusing on the assessment delinquency report to track which owners are behind on dues and collections. Finally, the auditor reviews expenses. Gather all signed vendor contracts, paid invoices, and 1099 NEC forms issued to independent contractors. Florida law requires boards to maintain these 4 record categories for at least 7 years. Without them, a valid audit cannot begin. Before the CPA arrives, conduct a self-guided forensic sweep of your own ledgers. Look for 3 specific warning signs of financial mismanagement. Here we see a mock bank statement showing a highlighted debit transaction. Florida law strictly bans the use of any association-issued debit cards, as they bypass the paper trail approval gates required by checks or electronic transfers. If any board member or property manager possesses a debit card tied to the HOA's bank accounts, destroy it immediately. Utilizing an HOA debit card is classified as criminal theft under state law. Next, check for the Interfund Borrowing shell game. This highlighted bank ledger shows an unapproved transfer moving money from the reserve fund to the operating account to cover a daily deficit. Borrowing from reserves requires a formal, recorded vote. Finally, review your check registry for round number vendor payments. Consistent payments to a contractor that are perfectly round numbers, like this $1,500 recurring charge without a line item invoice, indicate a risk of fraud. Spotting and neutralizing these red flags early prevents unauthorized borrowing and protects board members from third-degree felony charges related to kickbacks and undisclosed financial benefits. Once the audit is complete, Florida law imposes a strict statutory shot clock. The board cannot file the results away. They must be made visible to the community. For HOAs with 100 or more parcels, or condos with 25 or more units, the digital transparency mandate applies. The full completed CPA audit must be securely hosted on the association's password-protected resident web portal. This file cannot be removed after a few weeks. By law, it must remain accessible to all owners for a minimum of 1 full year. Combining accurate risk profiling, threshold awareness, and forensic readiness creates a community that remains in full compliance with Florida's financial reporting statutes.